Let's get started. Okay, thank you. Thank you, Nagaraj. Thank you very much.
Thank you.
How many people here own real estate? Almost everybody. Good. How many people here like to pay taxes? Nobody's raising their hand. Guess what? Most of you are going to pay taxes when you sell your real estate. Why? Because you didn't plan. Okay? With enough planning, almost anybody can avoid taxes for their entire life when it comes to real estate. So my job today is to explain why, not just with investment real estate, primary residence, second homes, all of your real estate, you could avoid paying taxes. And the secret is a part of the tax code called the 1031 exchange. Oops, hold on here. All right, 1031 is the part of the tax code that allows you to sell investment real estate, buy replacement investment real estate, and in doing so, you get to defer paying taxes on the profit that you've made. So what does that mean in English? You have a rental house. You want to sell that and buy a fourplex. So you call Nagaraj, he lists the property for you. At the close of escrow, the money comes to me. My job is to hold the money. We are called an intermediary. Nagaraj then finds you that fourplex you want to go buy. We send the money to the title company on that side, and the property closes. In the eyes of the IRS, you sold a piece of investment real estate, you bought a piece of investment real estate. And because you didn't touch the money, because we had it, you get to defer paying taxes. Now, we just talked about that. Now remember, 1031 only defers the taxes. It does not eliminate the taxes. So if you sell the house, buy a fourplex, later you sell the fourplex, buy an eightplex, now you're tired of real estate, and you just sell it. You pay taxes from the house, the fourplex, and the eightplex. You're just deferring paying taxes. Now sometimes I get asked, well, why bother? Why bother doing an exchange if I'm going to have to pay the taxes eventually? The two reasons. Number one, do you want to pay your taxes today or tomorrow? Tomorrow is the right answer. The way I look at it is this: if I make $500,000 of profit on a property, I'm going to have to pay about $200,000 in taxes. But if I do an exchange, I don't have to pay that $200,000. I get to use that money to buy more real estate. But the real reason you do the exchange is, when do you really want to pay your taxes? The answer is never, right? And guess what? You don't have to. Because eventually, sadly, one day, we're all going to die. And when you die, you win. Well, be honest. When you die, your children win. Because when you die, whoever inherits the property from you gets what's called the step-up in basis. Make sure we understand this. I bought a property many years ago for $100,000. Today it's worth $1 million. If I sell it, I have a $900,000 gain to pay tax on. But the day I die, whoever inherits the property, their value of the property is the value when I died, which is $1 million. And if your children are like mine, the day after I die, they're selling all my real estate. And when they sell it for $1 million, how much capital gains do they have to pay? Zero. All disappears when I die. By the way, this is also why it's much better, and I know we have an accountant talking about this, we'll make sure he talks about this. It is much better to inherit property than it is to give it to them while you're still alive. Because if you give the property to them while you're still alive, you are giving them your tax liability. But when you die, the tax liability disappears because of this step up in basis. Very important for you to know how to get the assets from where you are to your children or grandchildren, or however you want them to inherit it. All right, so let's talk a few of the mechanics of the 1031. Some of you may have heard of this. It's called a like-kind exchange. Like-kind is very confusing. Any kind of real estate for any other kind of real estate. You can sell rental houses for shopping centers. You can sell farms and buy apartment buildings. You can even sell bare land and buy rental houses. Any kind of investment real estate or any other kind anywhere in the United States. It does have to be within the United States. You cannot go back to India with the money, sorry. But it is any kind of investment real estate. But it does have to be investment real estate. So what about your primary residence? How many people have owned their house here more than 10 years? Many of you, all right? So chances are, if you've owned your house more than 10 years, you have way more gain than you are allowed to sell that property and not pay taxes. Because if you're single, you sell a house, you only get to keep $250,000 of the profit tax-free. If you're married, $500,000. If your gain is more than $500,000, that extra gain is taxable. It does not matter whether you buy another house or not. That's an important thing. The law used to be when you sold a house, you had to go buy a bigger house. Not anymore. Now when you sell your house, you get this automatic exemption. If your gain is more than that exemption, you pay tax on that excess gain. However, I don't want to pay taxes. So what do? Well, first off, does any portion of your property qualify? Do you have an ADU? Do you have a home office? Do you have any portion of your property that you are declaring on your taxes as an investment? If so, that percentage of the sales price you can do an exchange on. Most of us don't have ADUs though. So what do? Move out. Turn your house into a rental property. Now, after renting it for a couple of years, is that an investment property now? Yes. Is it still a primary residence? Yes. And you get to take advantage of both tax rules. So you can sell your property for $2 million, pocket $500,000, and then do an exchange on the remaining 1.5. So you can take advantage of both tax rules at the same time. So there's a huge advantage to that. What other properties don't qualify? Flipping real estate does not qualify for 1031. That's considered to be a job. Same thing with development. You also can't exchange it to any kind of a partnership or syndication. Second homes don't qualify. Now, most of you are thinking to yourself, it's okay, I don't have a second home. But I do have a condo that my son is living in. I always ask, is he paying you rent? No, he doesn't have a job. Well, guess what? That's not an investment property. Okay? You got a family member living in a home, that is considered to be a second home unless you're charging him market rate rent. So be very careful. You got family living in your property, unless you're treating them like a regular tenant, not investment real estate. So when you go home, call your son, call your daughter, tell them they're paying you rent, okay? All right, there is also vacation rentals. If you do have a second home, maybe you have a house in the beach or the mountains that you've been using for the family, you want to sell that, second homes have no tax advantage. But what a lot of people do is they'll convert the house to a vacation rental. And the IRS has told us if for 2 years, you can do this where you just rent the property for a few weeks per year, you and your family don't use it for more than 2 weeks per year, after 2 years, it's now considered an investment property and you could do an exchange. So again, with enough planning, you have a second home, you could turn the property into an investment. So again, any kind of real estate you have, with enough planning, we can get out of paying taxes. Just a couple of the mechanics of the 1031, because those are always asked. From the day you sell the property, you have 45 days to tell us what you're going to buy, though you have 180 days, about 6 months, to close the escrow. So 45 days to tell us what you're going to buy, 180 days to buy it. Both those clocks start the day escrow closes. So you have a very, very short time. By the way, the idea here of the 45 days, again, not a lot of time. 2 things to know. 1, ask for a longer escrow. When Nagaraj finds you a buyer for the property, by the way, if I'm running out of time, let me know. Instead of asking for a 15-day escrow, ask for a 45-day escrow, a 60-day escrow. The longer you're in escrow, the more time you have. There is also something called a reverse exchange. And one of the speakers today will be talking about how to fund them. But if you need to buy something before you sell, a lot of people are in today's market, that's what they like, because they know they can sell a property quickly, but they're afraid of not finding something in 45 days. So some of our clients do what are called reverse exchanges, where you buy first and then sell. I'm not going to get into the details about that. Somebody here a little bit later will be talking a little bit about that. But again, the key is it does exist if you are interested in it. Also, lastly, you do need to buy property equal or greater to what you sell the property for. Not the equity, not the profit, everything. If it sells for $5 million, you need to go buy something for $5 million. If you buy more, that's okay. If you buy less, you pay tax on the difference. So equal or greater to what the property is sold for, And all the equity goes towards the next property. Any cash left over, you pay tax on. Now, a couple of the problems with 1031s, family. You can't buy replacement property from family members. So the IRS is real strict about that. We're not taking questions today. If you come up to us afterwards, just because we have limited time for talking today. Anything you want to do with family, please be very careful. The IRS, the tax code has restrictions on doing 1031s with family members. Seller financing, if you're cashing out and the buyer wants to have you carry the note, that's a problem in a 1031. Vesting. It's whoever sells has to buy. If Nagaraj sells, he has to buy. He can't give the money to me to buy the replacement property. I often get the question, can I add my son to title? No. Okay, can I buy with other people? Maybe, it depends on the situation, but the key is it has to be the same taxpayer selling and buying. Also, foreign sellers can do exchanges. If you are not a U.S. citizen or permanent resident, you can still do an exchange, though you may be subject to something called FIRPTA, which is a federal withholding of taxes. Again, the key here is you can do it, a little bit more paperwork, a little bit more process, but if you have a situation where someone who is not a U.S. citizen or permanent resident wants to do an exchange, there are ways to do it. Lastly, what we do as an intermediary, you just know we are not regulated, so make sure you only work with big companies who can protect your money. Lastly, the reason people do exchanges is just not to defer taxes. Okay, if you own, and I've talked to a few of you already this morning who said that you already own rental property. That's wonderful. So why do you do a 1031? You do a 1031 because you want to buy something better. What does better mean? Better means whatever you want it to mean. It could be, I want better cash flow. I want something that's going to appreciate more. Maybe I'm moving to Colorado, so I'm moving my rentals to Colorado. Maybe I want to buy something that's less management because now I'm old and tired and sick of dealing with tenants. You do an exchange because you want to buy something better than what you have today. If all you want to do is defer taxes, don't sell it. Okay? If you want to not pay taxes, then fine, just keep that property. But if you want to buy something better, 1031 is the tool that gets you from the property you own today and what you want to own tomorrow. I'm kind of running out of time, so I'm going to skip the exit strategies and get to the end. And I want to thank Nagaraj for having me, and I believe the next speaker is ready. If anybody has any questions about anything I talked about, I will be in the back. I look forward to just working with you all. Thank you very much.
Thank you, Ron. That was mind-blowing.